series, we are growing a Robinhood account from $0 all the way to 1 million. And I'm showing you every step of the way how I get there. Now, in this video, I'm going to talk about how to make money in a market correction when there's a lot of volatility. You can make really strong, massive returns. I'm talking 2, 3, 5, 10, 50 times your money in a few hours or over the course of a few days. So I'm going to show you multiple strategies on how to not only time the market for when there's going to be a bounce, but also how to make more safer returns. If you don't feel like taking a lot of risk on short dated contracts, you can play like 2 or 3 weeks out and just watch the money roll in. So I'm going to show you a few different strategies of how to actually trade all this volatility. But if you've been following along, I want to start with how we actually knew that the market was going to have a correction and why we're net short, why we bought all these SPY put options for January, February, and March back in December. You can see that we talked about on December 7th, I said that we're going to have a larger correction in the market within the next 30 to 60 days. These would be my targets, and if it really sells, it could even drop 11.6%. And we took advantage of that. I post all my trades in here as they happen. We're taking profit on some of these. We're even up 187% on these February puts. So we took some profit, entered into some other positions. But let's just jump into the charts and then I'll go into those different strategies. So looking here at the SPY, this S&P 500 ETF, what we originally talked about was on the 7th. That was actually, funny enough, all-time highs. So the day after all-time highs hit, I said there's going to be a market correction, and looks like that's played out fairly well for us so far. Now we're just trying to take advantage of it. So when we were trading up around this 607, 608 level, we bought some put spreads out into the future. So we bought the 17th of January, we got the 21st of February, and then we got March 21st as well. So we didn't really know what price or how long this correction would take to actually play out. But typically what I like to do, if you can predict that this is likely going to happen, you would buy longer dated contracts and you would pick like this 585 level because we had this gap to fill. So price would actually come back down and fill this gap. So we bought like 580 to 576. That's what the target was for us. And then for February, we looked more out into the future at like 565 and 540. Those were all the levels that I was looking at and I was posting about in Discord. So I knew that this downtrend would play out, but I just didn't know how long, and that's why I spread my positions. Now that this downtrend is actually playing out, of course, we're always going to be taking profit on large down days on the closer or shorter dated contracts, and then letting these stay on a little bit longer, because ultimately when there is a downtrend and there's a lot of volatility, you're going to have wild swings in the market, and eventually it's going to have like a capitulation selling event, and that will be the ultimate bottom in the market. But now that the trend is actually going down, we don't want to chase. So human behavior always sees like this really strong down move, and they start to panic and they start to short the market, they start to chase, or they start to sell all their positions. And you have more of like a selling pressure in the market. But you can see here what happens is eventually there's a really strong volume candle and we push back to the upside. So there's a mean reverting counter trend to that downtrend. And usually the most amount of people are going short at the bottom and then they're going long at the top, right? So the market likes to create the most number of losers in the market. So you don't want to chase. You want to know where the puck is going, like Wayne Gretzky. You don't want to be where it's been. You want to know where the puck is going. So in a downtrend, I actually like to play to the upside. So there's a few ways to identify when there will actually be a local bottom in the market. And to give you an idea of this, there's actually, I will share this PDF, but this is called Lowry's report. And really what he found was when there's a selling climax, it's really nothing more than a period of panic behavior. And panic is not a matter of activity, but of intensity. And really what that is at the local bottom of these downtrends, there's this panic behavior. And during that time, there's a lot more down volume than up volume in the market, right? So most people are selling compared to the number of people who are buying. And usually when all the people are selling, there's like a mean reversion, right? Everyone sold, so where does price go now? Well, it has to go higher. And so there's some indicators you can look at here, but typically when downside volume is equal to 90% or greater, there is a strong counter trend to the upside. And so that's like a local bottom in the market. So I'll share this in the description. But going back into the charts, you can actually see it here. So let's take a look back at December of 2021. We had this really strong rally from the COVID lows. Obviously, there's so much volume here. Eventually, we push to the upside. The market's not going to have a crash like this. And I can talk about this if you want in another video. Just let me know in the comments. But I can explain why this actually happened and why it bottomed right around option expiration week in March. That's a little hint for you. But looking at like December, and this is probably something more likely to occur over the next year. I don't know how long this will go. It really depends on a few different things and what the Fed ends up doing. But if I was to actually see like, well, I want to time, the market broke down, you saw it break down, it started pushing. Well, how do I know when it's going to bottom? Well, you can see that volume is usually a good indicator that there's a local bottom, and then we had a really strong push to the upside. And if you look at the actual percent move here, this bottom we're at 421, and over the next week and a half, it went up 36, 37 points, almost 9%. So if you can time a 9% move in the market over a week or 2 weeks, you can make a ton of money. Now, what if you actually timed on the day of? Well, if you're playing like 0 days to expiration contracts, you could turn like $3 or $4 into like $100. So you could 25 times your money in a short period of time, just depending on how it trades intraday, what positions you enter, and if you get the right call contract at the right time with the right strike and your timing where price is going. Now, the way that I would look at this, if I didn't know that if I knew that the market was selling and I wanted to know when it was going to bottom, right? Well, the pretty obvious thing, just looking at, we'll get rid of the indicators here. So just looking at these candles, right? So like here, market like to bottom right around that 428 level, right? So I knew that, well, if I could only see up to this candle, I would think, well, at this 428 level, there's a lot of confluence there, that this area is a place where there's demand. It's a support zone. And you can see here, because volatility is so strong, it actually blew past it. And it came down to like where this candle bounced from previously. So you can use the past as a reference point to where you think there's going to be support, where those levels are going to be. But more importantly, you can look at other indicators, right? So if I look here, sorry, this is a bit of a mess, but I can show you a few different things I'd look at. So first and foremost, we can look at the VIX. The VIX, really that is how many SPX puts versus call contracts are being bought. It's really like how much volatility is in the market. You could just think of it as like the fear indicator. And VIX likes to move inversely to the market, right? So you can see here as it pushed down to this 422 level, VIX came up to a $32, right? So 32, and then even when it got up here, you can see there was an uptrend, and then at some point, it got up to like this 36 level, and then even back here around 31. And you can see that every time like VIX got over 30, there, at some point, volatility, it's really unstable. It's hard for it to sustain itself. And so you have, on all of these spikes, you see it come back down. It comes back down. It comes back down, right? So one way to make money is to actually play puts on UVXY. So let's go back here to Robinhood. I can show you UVXY. So say that, and if you just look over here like the last month, you can see there's a really large spike, right? So this was on the FOMC day, volatility spiked to, well, the VIX spiked to around 28, 29, and then you had this really strong downtrend in volatility because it's really hard to stay in volatility, right? Like people all panic and then the market digests all the information, then things kind of settle down and the VIX heads lower. And you can see here in this chart, if we go back to trading view, you can see that every time it hit 30, it would trend back to around 17, 18, like in that range. So a really safe way to play all the volatility is just wait for volatility to spike to the upside and then buy some UVXY puts. And if we go back here, so say volatility, we're going to have like a big spike in that. There's going to be mass panic. There's going to be a selling climax. Volatility is going to spike to the upside. The market's going to head lower. If there's really strong down volume, that means there's a capitulation event, and then we're going to have a strong bounce in the market. And so what I would be looking at is okay, well, I want to buy some puts. Well, typically volatility will take some time to digest. So usually I'd look at like 12 to 14 days out, so like a week or two. You could play shorter dates if you think that, okay, this is a really strong local bottom. There's a lot of down volume. I could just play like this 5-day contract, or I could play the 12-day. I'd probably play the 12-day just because it's a bit safer. And so say this UVXY spiked to around $30. Well, you could probably buy like 20% out of the money UVXY puts back to like if it got to 30, I'd probably be looking at like buying $25 puts 2 weeks out. And just to give you an idea of what it would probably be cost per contract, it'd be around like $30 to $40 most likely once it hits 30. And this would probably trend back to like 20. So you'd be like $5 in the money on, we'll just say $40 of premium that you had to pay for the contract. And so $5 divided by 40 cents, you'd 12 and a half times your money over 2 weeks. If you held it to maturity, of course. Now, usually what I would do is I'd probably just buy enough contracts, try to double my money, and then sell half of them, right? So now if I doubled my money, I sell half of my contracts, I've taken out my original risk, and then I can just let the other 50% of those contracts go. So that's like a nice tip, is just getting enough contracts and then selling half and then letting some runners go. So that way you have proper risk management. You can't lose any money because you've already doubled your money and you've taken that profit out. So try to like be smart, be patient, don't get greedy because the market's going to have a lot of volatility in both directions. So that's what I would be looking for. That's like the safer option if you just want to do UVXY puts when volatility spikes to over 30. If you just look at the VIX when it's over 30, you could probably start scaling into those positions, especially if there's a big drop in the market with a lot of volume. That likely means that we're going to find near-term support and we'll have a counter trend to the upside like we did back in, really December 23rd, December 20th was when it started. So that's what I would be looking for volatility. If you play shorter dated contracts, maybe just like hold it for a day or two. If you play those 2 week contracts, you could probably hold for like 3, 4, 5 days, even longer, just depending on how the market's going and where it's headed. If it's running into resistance or not, you'll want to take profit. Now, what I'm going to be looking for to take the most advantage. So these are for like those degenerate types who want to make 50 or 100 times your money. So what I'm looking for right now in the market is, let's just throw up the volume profile. You can see that there's a big volume node here around like 571. So we'll throw a level in there. You can see here right around this level around 565 is a low volume node. So price will like to come down and fill that area where there's not a lot of business, and price likes to move quickly in that area. And then even down here to like 561.67. So you can see that on a candle level, there's been resistance here at this 565 multiple times. We even held that level a few times. So that's a really strong level, that 565. So that's what I'm looking for right now. This 571 level, sure, on a depending if the market's not really like if VIX isn't spiking and the market's just slowly dropping, this 571 level might act as like an interim support. But what I really am looking for is that strong flush. I want the market to flush out, have everyone lean to one side, buy all the puts, everyone's selling. Then I want to be doing the opposite. I want to be buying calls when that happens. And when I think that can happen is around this 565 level. So that's kind of like my trigger point. Once that 565 level hits, I'm going to be looking for like 0 days to expiration call options on the SPY, or even like a few days out, maybe it's like 3 or 4. So there's like some different levels I'm going to be looking at. If it blows past this 565 level and hits this 561, 562 area, there's a lot of volume here. So I know it's going to probably be even a better level after this 565 is invalidated to buy those call contracts. And then if we look at this up and down volume, I can actually... I'll put it in the description below as well. But you can see here, this is what Lowry was really talking about in his report. And you can see that, on these levels, there's like 73% down day on Friday. So we're not quite at that like 90% down day to mark a bottom. You can see here, this was 85, 86%. That was the 2 days before we had that counter trend rally. So it doesn't have to quite hit 90% to have a response to the upside, but that's what we're really looking for, because that's where we're going to make the most amount of money. And you can also see it here. This was around like 82, 83%. So it's like something to watch out for when there's really low up volume and really high down volume. And if it's like 85 to 90% or even greater, then we're probably getting close to a local bottom in a downtrend, because like I said before, a downtrend is not a straight line. It's going to have really strong counter trend rallies to the upside as they occur. So we really want to just watch out for that, take profit on these shorter dated put contracts that we have, and then play those bounces. We want to play like, if we're going to just go here quickly, I can show you. If I was looking at SPY today, and on like the 13th, so say the price right now is 565. Well, I think that in a strong push to the upside on these candles, like SPY can really get moving. And usually when it's moving, it could even move like 2% on a bounce relative to its current price. So 2% would be, on the current price, would be 592. So that's like a huge bounce, right? That's 13 points on the SPY in one day. What I'd probably look for is where I can buy a good amount of contracts, but be close enough in the money to take advantage of that price moving, and then go in the money, which is really important, getting your contract in the money, because you only have 1 day to expiration. And once 4 o'clock rolls around, you have to be in the money to take profit, right? But usually you're going to take profit beforehand once it spikes to the upside. So what I'd be looking at is like 0 day, like 1 day or 2 day or 3 day. And I'd be playing something like closer to like 1% out of the money. So like this 585, right? So this 585 is going to cost me $61. But say it goes all the way to 592, which is like that 2% mark. 592 minus 585, that's a $7 swing. I spent 61 cents to buy it, and $7 divided by 61, that's an 11 and a half times my money. Now, when the market is actually selling though, that 585 strike is going to be extremely cheap, right? Especially if you're buying a 0 day expiration contract. This is 1 day. So there's still a lot of theta on this contract. You can see here 0.61. And during the actual day that the market is selling, this is going to be going for really cheap. This might be like 5 cents. So 5 cents, and if it goes to 5.92, I mean, just doing the math, 7 divided by 5 cents, that's 140 times your money. So you can see how crazy it is, but obviously this is a lot of risk. Obviously, don't size your whole account into this. Be smart about it. Risk only what you're willing to lose, because maybe you're not timing it perfectly, right? Maybe the market keeps selling, and that can obviously happen, but this is like more of a calculated risk, weighing the probabilities and hoping that you can take advantage of a bounce in a downtrend, which is personally what I think is a much safer and better risk to reward ratio than trying to chase the move lower if you don't already have those put options like I do. So hope you enjoyed this video. I'll probably be going live at some point just to talk to you, answer questions, go through a bunch of different charts. I can't cover it all here on this video, but really I hope you enjoyed, and I'll see you in the next one, guys. Peace.